Hi, good afternoon, everybody. Thanks for staying with us. This is Louis. I'm glad to be seeing you again. We are sharing with you our views on the Hong Kong and China market every 3 months. So my last seminar with investors in Singapore was October last year. First of all, I wish every one of you a very happy and prosperous new year. And amid this COVID-19 pandemic, I wish everybody will stay safe and healthy. Okay, let's start with my presentation today. Today, these are the key discussion points I'll be sharing with you. First of all, we'll review the performance of the China and Hong Kong stock market last year. And then I will also share with you an overview of China's economy and our 2021 outlook on China's economy. Then we'll share with you the index targets, the major indexes this year. And then last seminar, we recommend one stock which did very well, I would say very well. So we'll do a follow-up on the stock pick. I wonder if you still remember which stock we recommended last time, and whether if you had invested in that stock. Lastly, we'll share with you our stock pick this time. Okay, how China and Hong Kong market fare in 2020? For a China market, I think very satisfactory performance, but Hong Kong market lagged behind. Shanghai Composite Index was up 13.9% last year. So far so good lah. But the Shenzhen Component Index was up nearly 40% last year. You can see the trend, the trend of the Shenzhen Component Index. What had risen more is actually the Chinese version of NASDAQ. The CHINEXT was up 65% last year, making it the best performing stock indexes in the world 2 years in a row. So a lot of those companies listed on this board has risen quite substantially last year. As for the Hang Seng Index, if not for the late rally in December, our index, Hang Seng Index, would have dropped even more. Finally, it was down 3.4% in 2020. But entering 2021, the Hang Seng Index is catching up. The index has risen nearly 2,000 points in the last week of December and the first week of January. Okay. The Hang Seng Tech Index, we had also drawn attention, a lot of attention, which was listed in July last year. So the performance was not bad. It was driven by the tech stocks and the new technology stocks. The index was up 24.4% since launch. It was launched on the 27th July of 2020. So the index was seeing new highs this week. Okay, so there's a general overview of the major indexes of Hong Kong and China. Now let's move on to China's economy. Okay, as you may be aware, China manages a V-shaped recovery in the third quarter. You can see that after the dip in the first quarter, the GDP growth rebounded in the second and the third quarter, which was driven by industrial production, growth in industrial production, and also robust export growth. Sorry, let me get this block away. Yeah, okay. In this chart, you see two lines, the black one and the blue dotted lines. What is represented by the blue dotted line is the so-called Li Keqiang Index, which is compiled by taking 3 indicators, namely bank loans, which accounts for 40% of the Seng Index, electricity production, accounting another 40% of the index, and rail freight, accounting the rest, 20% of the weighting. So actually, these bank loans, electricity production, and rail freight, they can represent economic activity as well as manufacturing activity. So this Seng Index is more sensitive, more volatile than the GDP growth, but the main trend is quite in line. So it also manages V-shaped recovery in the second and third quarter of 2020. Actually, it fared better than the GDP, because GDP dipped below the drop into negative territory in the first quarter last year, whereas the Seng Index has never dropped below zero, has never dropped into negative territory. Okay. China is the first major economy in the world to show recovery. You can see from this chart, this is the GDP growth of major economies in the third quarter last year. UK was doing very bad. The GDP was down more than 20%, followed by France and Canada. Whereas China reported 4.9% GDP growth in the third quarter of 2020. We expect for the whole of 2020, China's GDP will grow by around 2%. IMF forecast China's GDP will grow by 1.9%. Our forecast is around 2%, whereas the world economy is expected by IMF to contract by 4.4%. So China will be the only major economy that can expect GDP growth in 2020. Okay, these are the growth engines of China's GDP. Fixed asset investment, you can see from this chart, this is fixed asset investment, and this is real estate investment, which is growing faster than fixed asset investment. So fixed asset investment growth accelerates in the last few months of 2020 on strong property investment. One thing to take note of is investment by the private sector, which accounts for 60% of total investment in China, showed the first growth during the first 11 months last year, the first growth in 2020, and real estate investment remained at an elevated pace. Property investment is supported by property sales, robust property sales. So this chart shows the property sales by floor area and value. The blue line represents the value in terms of value, property sales in terms of value, and the yellow line represents property sales in terms of floor area. So we can see starting since August last year, both sales by floor area and by value returned to positive in August last year, followed by sales by floor area in the 11 months of 2020. And real estate climax also this reflects the confidence of property developers. So in July, the real estate climax rose to 100.55, which is the highest in 2020, representing a recovery in the confidence among property developers. But one thing to take note is, as property sales recover, Chinese regulators have increased scrutiny on financing activities of developers and buyers to prevent rampant debt growth. So recently they have placed a cap on the amount of loans that commercial banks can lend to property developers and home buyers. So this will have a This will dampen the demand for property in the short term, and we expect property developers as well as mainland banks will underperform because of these cooling down measures by the regulators. As a result, land purchases by developers also fell more in the first 11 months of the year, fell 5.2%, worsening from the first 10 months, 3.3% decline. We expect land purchases to slow down further because of this curb on lending to property developers by the regulators. Okay. Retail sales posted the 4th consecutive month of expansion in November last year. So it has also accelerated the growth pace from 0.5% to 5% in November. And auto sales rebounded very strongly. So lately, you can see some of the auto car makers, the auto stocks in Hong Kong. Wow, they outperformed the market by a very big margin, such as Great Wall, BYD, and lately Geely also catching up. Auto sales saw 11.8% growth in November 2020. This year we remain upbeat on car makers, as can be shown in the case of Geely. They have finally managed to meet the target, the revised target for 2020, and for 2021 they set a sales target of more than 1.5 million units, representing a 16% increase as compared to the actual sales achieved in 2020. So Geely is expecting double-digit growth in sales this year. And because of the COVID-19 pandemic, online e-commerce also benefits. From January to November last year, online retail sales of physical goods increased 15.7%, much faster than the sales of the retail sales of consumer goods, and now is accounting for 25% of the total retail sales of social consumer goods. So actually, it is positive to e-commerce platforms, e-commerce players such as Alibaba, JD.com, and Pinduoduo. However, because of this antitrust investigation and antitrust legislation, Alibaba comes under pressure, and we in the near term, we do expect Alibaba to underperform because of the uncertainty rising from this antitrust thing. But competitors who stand to benefit from the legislation or the tightening of regulation will actually have benefited, such as Pinduoduo. Its share price gone up quite substantially in the last 1 or 2 months on the back of the news of the antitrust news. Okay. Surprisingly, China did quite well in exports. Exports surged at the fastest pace in almost 3 years. You can see from July to November, China exports jumped. In November, China exports jumped 21.1% year on year to an all-time high of $268 billion, which is the fastest growth since February 2018. Despite a sharp appreciation in the Yuan in recent months. So we are a bit surprised to see the strength in China's exports, but which is attributable to strong overseas demand for personal protective equipment because of the COVID pandemic. There's more demand for PPE and also for electronics products for working from home. as well as seasonal Christmas demand. So PC manufacturers such as Lenovo also benefits from these WFH, work from home demand, and its share price has outperformed the market. Okay, industrial output rises at the fastest pace in 20 months. So during the 3 months from September to November, industrial output rises above around 7%. It is driven by stronger demand, credit growth, and also stimulus taken by the Chinese government. Okay. As industrial activity recovers, you can see industrial profit starts to improve. In the first 3 months last year, industrial profits plunged very sharply. So in the second half of 2020, we saw a gradual improvement in both revenue and as well as profits of China's major industrial firms. The yellow line represents the revenue. So revenue now finally gets back to positive territory, up by still down 0.6%. The revenue of China's major industrial profits was down 0.6% in the first 10 months of 2020, but the drop is narrowing very quite tremendously. And the blue line represents the profits of those major industrial firms. So for the first 10 months, finally it gets back to positive territory, up by 0.7%. The profit increase is attributable to relatively rapid production and sales growth amid improving market conditions, as well as faster expansion of equipment and high-tech manufacturing sectors, and improving profitability of some traditional industries. So some traditional economy stocks also start to catch up in the last few months, last two months. And also the profits increase is also due to reducing cost cuts and companies reporting narrowing losses, reporting smaller losses. Okay. Now let's look at the inflation side. So consumer price start to come down. CPI, Consumer Price Index. The blue line is the consumer CPI. The light blue, the pale blue line is PPI, producer prices, whereas the red line is core inflation. So November CPI dropped 0.5% year on year. It was the first drop for the first time since 2009. But we are not too worried about this drop, and we are not worried that it implies deflation, because the decline was driven by improvements in pork supply. Actually, the moderation in pork prices is positive to the price level. And if you look at the core inflation, in November, core inflation in China rose by 0.5%. So core inflation actually is still positive. There's no threat. We don't see any risk of deflation in the short term. And then on the other hand, the contraction of PPI is also easing thanks to export growth. So PPI starts to rebound. Okay. As for the outlook of China's economy, we look at this manufacturing PMI as both official manufacturing PMI and the one compiled by Caixin Market. So both official and Caixin Market manufacturing PMI was holding very steadily about 50, the 50 threshold. That means that represents the manufacturing sector is still expanding. Although both indexes slowed down a bit in December, partly because there is this tighter electricity supply because of coal shortfall in coal supply because of the tension between China and Australia. So tighter electricity supply in last month caused interruption to the manufacturing of some small and medium-sized enterprises, but this only occurs in South China, and also the drop was due to a rather high base because of a very high base. Okay, so still not worrying as long as the PMI remains above 50. Okay, surface growth also slows down a bit in December. The official non-manufacturing PMI came down to 55.7 from 56.4, whereas the Caixin Market Services PMI also dropped slightly to around 56, but both are still at elevated, about 55 is regarded as an elevated level. Okay. So entering 2021, what are the top tasks of PBOC and what are the implications for investors? So PBOC, People Banks of China, pledged to make its monetary policy flexible, targeted and appropriate in 2021. We don't expect big moves by the Central Bank of China, and we also don't expect interest rate cut or because of the improvement as the economy is improving. So there's no imminent need for the central bank to cut interest rates, and then. PBOC also pledged to continue to rely on structural policy tools and credit policies to support small enterprises and extend deferred loan repayments for small businesses. Okay, in terms of interest rate, we expect the People's Bank of China to continue to use open market operations such as repo repurchase, MLF, medium-term lending facility, and the so-called TMLF, targeted medium-term loan facility to manage the liquidity of to manage market liquidity. And then PBOC also plans to deepen reforms of its loan prime rate while promoting deposit rate liberalization. And then another top task of the central bank will be to step up regulation of financial activities by internet platforms and regulation of payment services. So this one may have a bigger impact on fintech, on certain fintechs such as Tencent and Alibaba, which have their own e-payment payment gateways, and also the fintech business will be affected. And another top task of the central bank is to prohibit companies from over-marketing of financial products and luring consumers into excessive borrowing. This initiative of the central bank, we think is in a sense positive, is favorable to the traditional banks because the rise of fintechs have flattened the business of a lot of the traditional banks. So now the regulation on the financial activities of these fintechs, as well as prohibition, prohibiting them to do certain business, certain traditional business such as taking deposit taking, and lending. These are the bread and butter of traditional banks. So this prohibition will be in favor of the traditional banks. And lastly, another task of the PBOC this year is to implement prudential management of property finance and improve a policy system of financial support for the rental housing market, as there are signs of overheating in the property market. So the central bank, as I mentioned just now, had tightened the lending capability of commercial banks to the property sector. So this, we think this year property developers will continue to underperform the market because of regulatory headwinds. Okay. Overall, we are optimistic. We are upbeat about the China's economic outlook this year. First of all, the dual circulation initiative will spur greater recovery in domestic demand. So lately, a lot of the consumer plays in listed fare quite well. For instance, the sport goods company such as Anta and Li Ling, and dairy manufacturer Meng Liu, they as well as the brewery Qingdao Beer, Qingdao Brewery, and CR Brewery. So consumer plays will continue to fare well this year because of greater recovery in domestic consumption. The export sector, we expect it will remain a major growth engine this year. But one issue or one thing to watch out is the renminbi, the yuan. If it continues to appreciate, it may dampen exports. But we do think China will take action to curb the rise of the strengthening of the yuan. We also expect Beijing to maintain a stable and balanced fiscal and monetary policy. As I mentioned just now, no big moves are expected. Everything will be stable and steady. And then this year, we expect China's GDP growth to accelerate to 8%, to between 8% and 9% this year, which will be the fastest pace since 2011, when GDP rose 9.2%. It's a typical recovery, rebound model scenario after the drop last year, or after the slowdown last year. Okay, just now I mentioned yuan. Yuan is still under pressure to appreciate. You can see from this chart, it had formed a double head at 7.2 to $1 US, 7.2. And after breaching the support level of around 6.9, it starts to appreciate, and also accelerates in appreciating. To rein in the yuan strength, the PBOC and foreign exchange regulator, the SAFE, recently announced they will revise the macro-prudential adjustment coefficient. This is used to because the yuan is not a fully floating currency. It's still a managed float. So the PBOC and SAFE, they use this coefficient to manage the appreciation as well as the depreciation of the yuan, to manage the exchange rate of yuan. Now they announced that they will increase, they will raise the this coefficient to 0.5% from 0.3%. That means they will allow the yuan to move both ways, to allow a bigger range. We expect the yuan to move in a trading range of 6.7 to between 6.7 and 6.25 in 2021. 6.25, you can see that was the highest point for the yuan in 20 should be 2015, 2016. So there would be resistance at this level, 6.25. And after the appreciation last year, the sharp appreciation, we do expect some correction. And for yuan to correct, the support level is seen to be around 6.7 to US dollar, 6.7 to 6.25. Okay, what are our index targets this year? Okay, Shanghai Composite Index, you can see now is trending higher. Since hitting bottom 2 years ago, the rally was, now you can see the rally of the index. Our target this year for Shanghai Composite Index is 3720. Currently it's around 35 something, 3540. So there's about 6 to 7% upside for the Shanghai Composite Index this year. If investors are also upbeat about Shanghai Composite Index, these are the two ETF picks we come up with. This one is CSOP, China Southern Oriental Patron A50 ETF. The ticker is 2822. Our recommended buy price is 20 Hong Kong dollars. Target 22.5 and stop loss at 19. There's also another ETF choice that tracks the CSI 300, which is more diversified than the A50. So this ticker is the stock code is 3188. Is managed by China Asset Management Company. Recommended buy price is 65 Hong Kong dollars. The target is 75. Stop loss is 61 Hong Kong dollars. Okay. Hang Seng last year was down 3.4%. So this year we expect the Hang Seng Index to catch up. Our target for Hang Seng Index this year is 29,950 to 9950. Okay. The ETF pick, our ETF pick is Tracker Fund, stock code, the ticker is 2800. Recommended buy price 27.4 Hong Kong dollars. Target 30.2. Stop loss at 26 Hong Kong dollars. Okay. Okay, as for the Hang Seng Tech Index, Technology Index, recently it has saw new highs. It has seen new highs, rising to around 8,600 points. Our target for the Hang Seng Tech Index this year is 9,600. And our ETF pick is the CSOP Tech Index ETF. Stock code is 3033. Recommended buy price $8.30 Hong Kong, 8.3 Hong Kong dollars. Target 9.6 Hong Kong dollars, and stop loss at 7.7. As more Chinese tech companies will get a secondary listing in Hong Kong, so this will benefit the tech index. It will add more constituents to the tech index, and also will give impetus to the index to rise further. Okay. So follow up on previous stock pick. I wonder if you remember what stock we recommended last time in October in my English e-seminar. The stock we recommended is Geely, 175. So a review of its latest business performance. Geely Auto and Link, the joint venture, it owns 50%. These linked brands, the sales achieved 1.32 million in 2020, beating its revised annual target of 1.31 units. So they managed to beat the revised annual target. In 2020, Geely Auto also celebrated its 10 millionth vehicle sold, becoming the first Chinese brand to reach that historic milestone. Of course, we're not comparing to the JVs, the JVs with Japanese car makers or with US car makers. Their sales are much bigger. But for homegrown brands such as Great Wall, Geely Auto, and BYD, Geely is the first Chinese brand to reach the 10 million vehicle sales number. And then Geely Auto continue expanding its global presence with new models launched in Russia, Philippines, Kuwait, Saudi Arabia, and Myanmar. Last year, a total of 72,700 vehicles were exported, a year-on-year increase of 25.3%. Okay. This year, Geely Auto will focus on adjusting its product strategy, introducing new models, and set its annual target for 1.53 million units, a 16% increase from 2020. So Geely is quite upbeat on the outlook in 2021. The Geely Auto brand will unveil a new CMA base. CMA stands for Compact Modular Architecture, developed in cooperation with Volvo Cars. They will unveil a new CMA-based SUV and sedan, as well as several updated models. And for its 50% owned joint venture brand, Link, they will also launch a new model. In addition to the pure electric Link & Co.'s model called Zero, they also launched another model developed on the Scalable Product Architecture, SPA, which will also be unveiled soon. Okay, one latest news on Geely is cooperation with Baidu on these intelligent driving. So this will be the next growth engine for Geely. Geely Auto plans to raise $2.94 billion US dollar via listing on Shanghai's Nasdaq style star market, 科创板, making it the first automaker to be listed on the star market. So this will help strengthen its coffer. The proceeds will be used for developing new vehicles and technology. And before the two companies, Geely and Volvo, they are in talks of a merger. But because of the COVID pandemic, the talks was put on hold. But now the management of Volvo indicates that they will likely resume the merger talks in the first quarter of 2021. So if there's a merger to take place, it will also strengthen Geely's competitiveness in the China's auto market, car market. Okay, last year we recommended in my October e-seminar, we recommended to buy at Geely at $15. So, So its share price started to rise in November last year and accelerated even more in 2021. Lately, a lot of investment banks have revised upward the target price of Geely to about 50 Hong Kong dollars. Currently, it's trading at 33. So compared to our recommended buy price of around $15, actually, share price has more than double. It has gone up by 125% since our recommendation, and also far exceeding our target price of 19 Hong Kong dollars. But at this elevated level, we don't recommend those who have not owned the stocks yet to go in. But for those who are still holding this stock, because as I mentioned just now, some analysts have revised upward the target price to about $50. So you can actually continue to hold and net profit run. To play safe, those who bought at much lower levels can place a stop profit price at around $28 to $29. That means if its share price manages to hold above $28 to $29, then you continue to hold stock and look for more gains from it. Okay, there's a follow-up on our last recommendation. Let's come to the stock pick this time. Okay, what is the stock pick? If you see this photo, I think you know which stock we are recommending. We are talking, which we'll be talking. This is YUM China. It's listed in the New York Stock Exchange, sticker YUMC, and then it had successfully listed in Hong Kong, secondary listing in September last year, and the stock code on the Hong Kong EX is 9987. YUM China is the largest restaurant operator in mainland China based on 2019 system revenue. Its growing restaurant network consists of, I think all of you would be very familiar with its brands, the KFC brand, Pizza Hut, as well as some emerging brands such as Little Sheep and Huang Ji Huang. Little Sheep and Huang Ji Huang are both hot pot chained restaurants selling hot pots, Chinese hot pots, and they have also their own their own restaurant selling or cafe selling coffee and joy. East Dawning 东方既白 is a Chinese fast food chain, and Taco Bell and Lavazza. Lavazza is the JV, their JV with a very famous coffee brand in Italy. So they are bringing together their own coffee brand, Coffee and Joy, as well as Lavazza, to expand in the emerging coffee market in China. So total store count reached 10,150 at the end of September last year. Now their restaurants, their stores, cover over 1,400 cities in China. You can see, despite the pandemic, they continue their store opening pace. In the third quarter last year, they opened a total of 660 new restaurants for the first 3 months. For the first 3 quarters in 2020. And in the third quarter, they opened 312 restaurants, mainly comprising KFC, 227, and others include Pizza Hut and Huang Ji Huang and Little Sheep. So as of the end of September last year, total restaurants operating in China reached 10,150. KFC accounting for nearly 7,000, and Pizza Hut 2,277 restaurants. Others coming to close to 1,000 restaurants. Okay. The other slides, I will show you the revenue breakdown. So to Yum China, KFC still accounting for nearly 70% of the revenue. In the last 3 years, its share of revenue of the group came in at between 65% to close to 69%. Actually, in the first 6 months of 2020, KFC accounted for more than 70% of the total revenue. And then the other 20% or so came from Pizza Hut. And then all other segments accounted for about 1.5 or close to 2% of the total revenue. So for the last 3 years, the revenue increased quite steadily. And of course, we don't see those, the kind of sharp rise. It's slow and steady. From 7.7 billion US dollar to 8.4 billion US dollars. Last year was 2019 was 8.77 billion US dollar. But for 2020, we do expect, because affected by the pandemic, that its revenue and profit will be adversely affected. So you'll see a drop in the revenue in the whole year of 2020. Okay, another highlight, investment highlight of the company is digital and delivery capability. Yum China has one of the largest digital audiences in the world. It has more than 285 million members as of the end of September last year, a gain of 55 million compared to the third quarter of 2019. And sales coming from these members accounted for more than 60% of system sales. So these are the faithful customers or the repeated purchase from their member. As for delivery in the third quarter of 2020 accounted for about 28% of the total revenue. But digital orders, that means clients placing their orders online, accounted for nearly 80% of their sales. So Yum China is quite ahead of the, compared to its competitors in terms of the digital development as well as delivery. As for delivery, it has its own delivery team. Also, it leverages on third-party delivery platforms such as Meituan, Eliaome. So it also leverages on third-party platforms. Okay, the business strategy of Yum China is to grow sales and profits across its brand portfolio through both organic growth and as well as growth of franchises and online business and development of new restaurant concepts. Currently, about 1/5 of their restaurants are run by franchises, franchised. 4/5 of the restaurants are company owned. So this will imply better management by the company, and its long-term goal is to build a network of 20,000 restaurants. So it has a long-term plan to nearly double its restaurant network, is the number of restaurants from the current 10,150 to 20,000. Through the secondary listing in Hong Kong, it raised about 2.2 billion US dollars. So this bolstered the company's total cash and short-term investment balance. At the end of September last year, it is sitting on a cash of 4.2 billion US dollar, and the company has no debt. Okay. As for the use of the IPO proceeds, the company plans to use the proceeds to expand and deepen restaurant network, invest in digitalization and supply chain, and also invest in food innovation and other value proposition, and also will seek high quality assets to invest. The rest of the proceeds will be used to replenish working capital and general corporate purposes. Okay. So this is the financial performance of the company in the last few years. So until 2020, this is 2019, you can see that the revenue as well as the profit both grew very steadily from 2012, 2013 to 2019. But last year, we expect a drop in the revenue as well as the profit because of the COVID pandemic. But we do expect the company to be back to growth mode in financial year 2021. This is our 2021 projection. Revenue is expected to grow 19.8% year on year to $9.8 billion in financial year 2021, and net profits is expected to grow even faster, to grow by 34% to $840 million. The company's earning per share is expected to grow by 28% in 2021 and subsequently at the rate of 9.8% per annum in the next 5 years. So the company is also seen as a defensive stock in terms of dividend payout. If it manages to grow at this expected rate, close to 10% per year. So we also expect stable growth in its dividend payout in the next 5 years. It has suspended quarterly dividend payout last year because of the COVID-19 pandemic, but the company has stated that they will resume paying dividend in the fourth quarter of 2020, last quarter of 2020. So this year, as their business continues to recover, we expect and they will pay out more in dividend to shareholders. Okay. Our target price for, because it's listed both in the US and Hong Kong, so we have a target price, a US dollar target price as well as a Hong Kong dollar target price. US dollar target price 69 US dollars. We recommend to buy at 57 and set a stop loss at 52.5 US dollars. As for the Hong Kong target price, we set at 545. Currently, it's trading at 455. So there is 90 Hong Kong dollars upside. We recommend to buy at 448 Hong Kong dollars and stop loss to place the stop loss at 420 Hong Kong dollars. Okay. Okay, so it's shorter this time round, so I'll leave a bit more time for Q&A since I noticed there are 50 over questions being asked. Okay, let's see what question the audience have. Okay, please share your views on the Hong Kong stock market. I have already stated earlier that we expect the Hong Kong stock market to catch up this year because of the risk appetite among local investors are also improving. Our index target for Hang Seng is 29,950 this year. So 10 cent Ping An Insurance Link REIT Hong Kong Exchanges Tracker Fund. Okay, These are the most popular questions. Okay, Tencent. Long term, we still like the company, but short term, is facing certain uncertainties. For instance, will there be any restriction or ban from the US, as well as the fintech part may be under scrutiny by Chinese regulators, because it also owns e-payment gateway, the 微信支付. This may come under tighter regulation by the Chinese authority. But its advertising as well as online game business are still very strong. So Tencent should be resilient as compared to Alibaba. We expect support at 555 Hong Kong dollars, the near-term support. If one wants to buy Tencent, 555 is also a recommended entry price. The target will be the first resistance level will be $600, and if it manages to breach the resistance level of the $600 resistance level, the next target would be 630. Ping An should benefit from higher bond yields in China, because as in the US, we notice that bond yields are edging up. In China, the thing we also see the same thing. That is, interest rate and bond yields are edging up, and also the A-share market, more brisk, active A-share market or rising A-share market should also be in favor of Ping An, should be favorable to Ping An. So we expect its share price to test the 100 Hong Kong dollar level this year, and support level is seen at around 88 to 19 Hong Kong 90, 88 to 90 Hong Kong dollars. Link REIT has rebounded quite substantially recently. So in view of the local economy, Hong Kong economy is still bad, affected by the COVID-19 pandemic. So of course, Link REIT is more resilient as compared to other commercial REITs in Hong Kong. However, there is still downward pressure on the rates when the lease expire, and upon lease renewal, we do expect downward pressure on the rental rates. So Link REIT, I think, has rebounded quite substantially. So it will meet resistance at around 75 Hong Kong dollars, and the support level or entry level would be 65. If it corrects back to below 65 Hong Kong dollars, then those who want to buy Hong Kong REITs can consider buying at below 65 Hong Kong dollars. Hong Kong EX, very strong this year because of now the market turnover has surpassed 200 billion Hong Kong dollars a day. So we do expect a good year this year, because we are projecting 29,950 for the Hang Seng, and if the stock market continues to rise, market turnover will also follow. Okay, so that will be positive to Hong Kong EX. And secondly, Hong Kong EX will also benefit from more secondary listing of Chinese companies from the US. So last year, NetEase, JD, they were listed in Hong Kong. So this year we expect more to come, such as VIP, Wei Pinghui, and also some spin-off such as Jingdong, JD Logistics will also benefit EX because of more spin-off from those fintech giants. Okay, our target price for Hong Kong EX is this year is 495 Hong Kong dollars. Actually, now is quite close to this target price. Is trading at around has risen to around 450. So the ups, because it has risen too rapidly in the last 1 month, so the upside would not be too attractive. 495 representing 60 times forward PE of its 2021 earnings. Okay, as for Tracker Fund Hong Kong, just now you can see in my chart, in my slide, in my PowerPoint, that our target price for 2800 is around $30, around $30. Banking on the Hang Seng Index will hit 29,950 this year. Okay. Which ETFs do you recommend to have access to China stocks? If we are talking about just A-share index and CSI index, just now I have recommended 2 ETFs, the 2822 and 3188. These 2 ETFs tracking the A50 index and the CSI 300 respectively. Okay. Can you provide the full list of Hong Kong listed stocks affected by and your thoughts on whether Biden will reverse it? It's quite a long list now. It's getting longer. Maybe we can. I can ask my colleague in Singapore to send you the information, the list of Hong Kong listed stocks affected by Trump's executive order. Here, because offhand I cannot show you the list. My thoughts on whether Biden will reverse it, it's possible, but I think Biden will not rush to reverse it. And also there are a lot of ifs because the executive order has led international index companies to remove those affected stocks from their index. For instance, and also even worse, NYSE, the New York Stock Exchange, has decided to delist the 3 China telco companies. So even I mentioned just now, there are a lot of ifs. First, if Biden will reverse it, not sure. But even if Biden decides to plans to reverse it, it may not. It will take time. Okay, so that's the first uncertainty, the time factor. The second uncertainty is even if Biden reverses it, will the international index company add back those companies to their indexes? Because a lot of the indexes are followed by passive managers, the so-called ETFs. So the share price suffer because of the removal from the index. The removal from the index. This will force the passive managers to sell those stocks they are holding. So I don't think the reversal will come very soon, and these companies will still come under pressure even after Biden taking office as the next US president. But to differentiate among the companies that are affected, if those companies that have good fundamentals, strong fundamentals, and good prospect, I think they can manage to be not affected very adversely by the executive order. For instance, this SMIC, its share price rallied lately on Friday on the news that it is raising the prices of is cheap products, is chips. So for fast-growing companies, I think they will even if they are affected in the short term by by Trump's executive order, but over the long term, if they manage to continue to grow, the revenue and earnings continue to grow, the fund flows will come back. But for the China telco companies, I'm not that optimistic because they are already under pressure to cut tariff. So their earnings in the last few years grew at a very very slow rate, low single digit kind of growth. So together with this Trump's executive order, it is they even suffer more. So we don't recommend buying those three Chinese telcos stocks, despite the share price are very cheap and look attractive. Okay. Do you still recommend Yum China, and what is your latest buy price? I think this audience has attended my Mandarin seminar last month, because in my last seminar in Mandarin, in Putonghua, I recommended Yum China. Yes, December, yes, last month. But the price has not hit the buy price of 428 since then. So just now let me get back. I have raised, now I remember, we have raised the buy price, the recommended buy price to 445. Okay. The last chart, yeah, 448, sorry, 448. So because its share price has not gone down to our recommended price in December's e-seminar, so we decide to revise it upward to 448, and the target price remains at 545. Okay. Bank stocks like Hang Seng Bank, Hong Kong Bank, CBC, ICBC worth of buying at current price? Is China ETF like 3188 worth to buy at current price? What is the target price? Okay, HSBC, I don't think its share price has rebounded, I think more than 50% from a recent low around 27 Hong Kong dollars. So now I don't think it has a lot of upside. For HSBC, our target this year, the upside target is $47. So now it's trading at 43. So there may be another 10% upside. But we don't like recommending stocks that give a less than 5% ROE. The ROE is less than 5%. So there are more better companies. Even Hang Seng, to choose between HSBC and Hang Seng, I would rather pick Hang Seng because of higher ROEs and higher dividends, share dividend. Okay, as for mainland banks, the state-owned banks, actually we favor China Merchant Bank, CMBC, more than the state-owned banks. Both 939 CBC, Construction Bank of China, and ICBC, they look cheap, but the point is they're cheap. The low valuation also reflects their rather weak profitability. So we would like to, instead of going into Construction Bank of China and ICBC, I think a better pick is CMBC, China Merchant Bank. Okay. Is medical stock like 6562269 still worth buying? Is tech stock like 9988 Alibaba worth of buying at current price? Okay, so a lot of the audience may also have similar questions. Medical stocks like 2269, those engaged in pharmaceutical R&D companies, we think is still worth buying. But pharmaceutical companies such as 1093, and 1177, because we don't recommend to buying at the current price, and also at this under this current situation, because the procurement policy taken by China to bring down the drug prices, prices of pharmaceutical goods, is having a tremendous pressure on the margin, on the profit margin of those pharmaceutical companies. So you can notice that both blue chip 1093 and 1177, which are both Hang Seng Index constituent stocks, they underperform the market, as well as underperform other medical stocks. So 2269, okay, because it's more in the R&D part. 656 is quite diversified, so 656 is also okay, if you ask me, as compared to 1093 and 1177. For those who are holding 1093 or 1177, and you are still having a floating loss, maybe you should consider switching to other medical stocks, especially those which are more actively engaged in the R&D part of the value chain. Okay, tech stock, Alibaba, no, should not consider at the current price, because there are a lot of headwinds the company is facing, especially in China, the antitrust, as well as the regulation of fintech, and also there are talks that Ant Financial is mandated to break up into Alibaba to break up Ant Financial into two companies. This will, I'm afraid, this will weaken the profitability of Ant Financial as well as Alibaba if the company has to be broken up. Okay, Xiaomi is now in a correction phase. So I think one may wait for a lower price to go in, because its share price has gone up quite substantially, partly because of the switching, the fund flows out from Alibaba and Tencent into Xiaomi. So actually it becomes a safe haven, because it's not it has a lower risk, a small risk of the antitrust problem. So let me see what price to recommend buying on this correction. 1810. Okay. Now Friday it closed at $31.95. Okay, so if his share price, we recommend buy when his share price correct further to between $29 and $30. $29 and $30. Okay. 2382. Yes, we are Sunny Optical. We are still upbeat on this company because of more demand for 5G handphones this year, and the share price actually has risen quite a lot at the beginning of this year. So wait for correction. If there's any correction, better entry level would be 175 Hong Kong dollars. Friday it closed at 189.1, so we recommend to go in at 175 Hong Kong dollars. 2018, if compared to 2382, we are less upbeat on this 2018. Because it's more exposed to the acoustic business rather than the optical business. Now, optical business, the difference between Sunny Optical, I mean, also the share price, the reason for the strength in the share price of Sunny Optical is now market are more upbeat about the optical business part rather than the acoustic. But it's possible that its share price will have some catch up since it is still trading at a rather low level. If it managed to rise about $47, one may look at 50 50. But to go back to the peak in August last year, it dropped from above $65. So even if it rebounded to $50, it's still way below the peak seen in August last year. That reflects the profitability of the company and the the less promising prospect of the company. So if you can buy at 45 and target 50 Hong Kong dollars and the stop loss price is 42 Hong Kong dollars. Okay. What else? It's consumer stock like 1810, 175, 2020, 291, 9630, 2319 good to buy at current price. All of them are very expensive now. Xiaomi, Anta, Geely, CR Brewery, Longfu Spring, and Mengniu, all quite expensive at the moment. So one tip advice to investors is when you see the share price rising too rapidly and moving away from the 10-day moving average. If it's too far apart from the 10-day moving average, don't jump in. Wait until there's a correction, until the share price correct to close to the 10-day moving average. Then it will be a better entry level. Now take Enter Sports as an example. 2020. It's now trading at 131.2 Hong Kong dollars, and its 10-day moving average is 125. So it's still above the 10-day moving average. One thing good about using this strategy of getting in when the share price corrects to the 10-day moving average is the 10-day moving average also moves along with the share price. If the share price goes up, the 10-day moving average will follow. So you just need to track the 10-day moving average where it lies at the moment, and then when there's a correction, the price corrects back to the 10-day moving average, then it's a safer entry level. Okay. What is your view in Hang Seng Tech ETF long term? As China government is probing in Alibaba's business, it's dropped quite a lot last week, even though it recovered to new high now. Alibaba's price is still under pressure. But as you mentioned, you're right. The Tech ETF, Hang Seng Tech ETF, has seen new high. It's because I think I'm upbeat on this Tech Index ETF, and it is one means investors can take part in or benefit from the development of tech companies in China. It's believed that tech companies will grow much faster than the overall economy, and then buying a tech ETF, tech index ETF, investors will stand to benefit from the profitability of those companies. I think one thing about this tech index ETF is more companies will be added, so the influence of one single, a few companies such as Alibaba, you can see it's an illustration that even Alibaba's share price are under pressure, but other tech stocks continue, such as Xiaomi, 1810 continue to, the share price continue rising. It will still manage to bring the tech index to a high level. So it's better, even better than buying single stocks. So I do recommend on two reasons. One, I'm personally, I'm upbeat on the development of tech companies in China. So they will grow faster, much faster than the overall economy. And the other reason is it's better to pick just one stock. If you pick the wrong stock, such as Alibaba, because of the unforeseen kind of political uncertainties, then you get hit by the uncertainty. But if you choose the index ETF, it will offer you diversification and also is a basket of tech companies. So I'm for buying Hang Seng Tech Index ETF. Just now we recommend to buy 3033, the CSOP Tech Index ETF. Our target price, let's go back again to the target price of our tech Hang Seng Tech Index ETF. Earlier. George, earlier. Go up. Yeah, here. Okay, once again, our ETF pick for Hang Seng Tech Index is 3023. Recommended buy price is 830. Target price 960. Stop loss at $7.70. Okay. Is it better to buy YUM China in NYSE or Hong Kong SE? It depends on you because there's a time gap. You can compare the share price, but I think Hong Kong SE, it's better to buy the one listed on Hong Kong Stock Exchange because of more fund flow, southbound fund flows from China, which may benefit the Hong Kong listed share price. Okay. What happened to previous Hong Kong stock picks, Ping An and Zhong An? Ping An is still okay. Just now I mentioned Ping An is still outperform other Chinese insurers, especially China Life. So Ping An, we expect the share price to test the $100 resistance level this year. But Zhong An is a bit of a disappointment to us. So in view of its lackluster performance and also in terms of business performance, it's not very outstanding. So we will recommend those still holding Zhong An to switch. Either if you are still upbeat on Chinese insurance, we recommend to switch into Ping An, sell Zhong An into Ping An. Another insurance company we like is AIA 1299. Its share price is even stronger than Ping An. So the two insurance company listed in Hong Kong now are favored by us are Ping An and AIA respectively. So Zhong An, if you we recommend cutting loss and switching into either Ping An or AIA. Okay. Can you give a sense on the US delisting of the Chinese telco companies affecting the stocks in China? Example, China Tower. This will be, rubbing salt to the wounds lah. Because China Tower, we never like. Actually, the company is itself is okay. China Tower, the earnings growth is decent, but the point is the valuation is what went wrong with China Tower is the valuation. Its value is listed on a very hefty valuation. More than 90 times of historical PE. So despite the earnings growth, its share price continue to drop, to correct. Now it's trading below the listing price. You just imagine why a company listed for 3 years, since 2016 or 2017, 3-4 years, still a very solid company. China Tower, it has the monopoly of owning and operating the towers, the telco towers in China, and then it has very stable customers such as China Mobile and China Telecom, and earnings also grew steadily over the last 2-3 years. So what went wrong? Why share price continue to drop? It's because of the valuation. Sometimes companies are good, but if you don't look at the valuation, if you invest in companies without looking at the valuation, you may still lose money. That's one example with China Tower is a good example, because the value at current price level is still trading at more than 30 times forward PE for 2020. So it's still not cheap. But 2021, if its historical PE continues to fall because of the earnings continue to grow, so there may be a chance for China Tower to rebound a bit, but we are not looking at a big rebound. We are only expecting if its share price can rebound to $1.50, because it will be bound by the valuation, the high valuation. So whether the three telco companies will be delisted from the NYSE, I don't think it will affect China Tower very much, because it has its own woes, its own problems, and that is the high valuation. Okay, so one last question, because we are going to end the presentation at 3, slightly earlier than schedule. Okay, what do you think about PDD, JD, and Alibaba in 2021? PDD, we like PDD, both PDD and JD. Alibaba, because of the political uncertainty, we recommend to avoid for the time being, to avoid Alibaba. And also there's a rumor that Ma Yuan have not shown face since October last year. So uncertainty surrounding him would still have dampening impact on Alibaba share price. PDD has share price has risen quite substantially because it is seen to be benefiting from the antitrust, because it's the smaller player among the 3 e-commerce giants. So its share price actually benefits. So this year, I think JD is still worth looking at in terms of relative share performance, and also the antitrust negative would not be as big as Alibaba. And JD still have spin-off concepts. Last year, JD has spun off JD Health, which has done very well on the Hong Kong market. Currently, JD Health is under correction, but we do expect the price to resume is uptrend after completing the correction. And then JD will spin off 2 more companies this year, namely JD Logistics to be listed in Hong Kong and JD Financial, Jingdong Suke to be listed in Shanghai. So the spin-off, the separate listing will further enhance its share value, will help enhance its valuation. So among the 3, if you ask me, I think JD is still quite attractive. JD, let me see what price we recommend to go in. The stock code is 9618. I think 335 to 340 is a good entry level. 335 to 340. Okay. The upside target will be our upside target for JD this year is between 390. If you buy at 335 to 340, the stop loss can be set at 315. Okay. So thank you for your time today. Thanks for staying with us. I hope everyone again very happy new year, happy and prosperous new year. We'll be seeing you soon in another 3 months. English e-seminar, next English e-seminar will be in April. But I'll be also hosting a Chinese seminar next month in February. So watch out for the dates of my Chinese e-seminar. Thank you.